Hey everybody, so this video is part of the series of how to use yin-yang indicators, and we will be covering our Yin Yang B indicator, which is an oscillator for both price and volume. So if you've ever used an oscillator before, you'll probably know a general standpoint on how most of them are used. But for those of you who don't, let's just quickly explain a few things. So it's not based on RSI calculations, but I do like the expressions used with them, where this is the neutral line right in the middle here. This is slightly overbought, and this is very overbought. And in here is the sweet zone for when it's generally a good time to sell, and this is slightly underbought and very underbought. And then here is the sweet zone for when it's generally good to buy. Anything lower than this right here, or higher than here, is very good strong spots to either sell or buy. And I wouldn't only base it off that. We are just going over this one indicator right now. We will have a video later on, or maybe even a whole series of how to use all the indicators in conjunction with each other. But for now, we are simply discussing Yin Yang B. So I find it easiest if we discuss it without all the other data on first, and then at the end we can talk about the rest. So first off, let's discuss this trend line here. So it is from the predictive to the confirmed, and that's how it's evaluated, with green being predictive support, to red being predictive blood diamond, from the predictive to the confirmed. So it starts, so it'll turn green when the predictive and the confirmed for both support are true. And it turns red when both the blood diamond for predictive and confirmed are true. And it's a good idea of when things will likely go down. So there'll be times where, it'll do this little spot where you'll have like these little back and forths. But generally speaking, when it happens, it's quite accurate for how much movement is going to happen where. So it's not the purpose of this indicator, to be honest. The purpose is for the ice and the mountains with volume for the price too. But this is a good thing to look at because when it also crosses with the mountains, as we'll show later on, it can be a solid marker for when there's going to be a momentum swing. As its own, it can be useful just to look at, but I wouldn't solely rely on it as something to trade on. So why don't we turn on the price ones? So first off, before we do, you have your regular, your predictive, and your confirming, and then you can select a combination of any and all in between. I personally recommend doing predictive plus regular, and so they overlay on top of each other a bit. Now let's just turn off the trend line for 2 seconds, just so we can just discuss it as a whole. So with each one that's turned on, first off, you're going to see these squiggly little lines. So they are a representation of the moving averages for both predictive and confirming. So like as you can see, when we just go to regular, we're only going to have one of those lines because it's only got one MA in moving average. So that's the predictives, what it looks like by itself. As a regular, predictive is green, and it looks like that, yeah. But when they're together, there's a reason why it's so powerful. So the moving averages, they can be useful for when they cross, as it can indicate momentum swings, but I don't honestly use them as much for that as I use the size of the mountains. So to discuss these mountains and how they work is basically you have the dark blue in here, that is the mountain. The stuff coming off of it here is the ice. The dark green here, or light green, I guess technically, but the solid green that's darker is the predictive mountain, and then the ice here is the predictive ice. So you have regular mountain, regular mountain, regular ice, predictive mountain, predictive ice. And then also they have their support crosses and blood diamonds. The red cross and red circle is for the regular mountain, and the white cross and the white circle is for the predictive. So now that you know that, we can, and they also correlate to the Yin Yang A's locations for the blood diamonds and supports crosses too. So there's something I like to describe as basically the perfect condition, or just like, what's it called? What do I? Oh, what I like to call it is the perfect combo or condition. So basically, it's when the ice. Here's an example of it, even though it doesn't always work perfectly because sometimes there's other factors, but also there's volume that counts for it. So this is the perfect condition here. You do want them a little bit more spaced out here, but basically it's when they come all the way down and they're either right touching the under, so like the very underbought, or they even go under it. If the regular touches it, that's good. If the predicted goes under it, that's good. If they both go under, that's even better. But this is really good. It's they're a little too close because this one candlestick here was just so drastic that they just both moved. There wasn't like it wasn't a smooth movement. But that's not a bad thing because usually there is a very big corrective swing after such a candlestick like that. But it's what you when you see this, the predictive ice starts to curve into the predictive mountain, and then you get support cross, and then shortly after the regular ice curves into the regular mountain, and then you get the regular support cross. When that's combined with a big volume mountain, it's a very, very strong indicator that you're going to have a very it's a very bullish indicator that you're going to see some strong movement, as you saw here with that one wick. Normally it represents more than that, but that itself is pretty good. You see it here, and especially because of how drastic this ice cut in on both of them, and then on the same candlestick, you got both of the support crosses for right here. Boom, went right up. This one, and see, they're not as low as I would like, but still they're pretty low. This one, I wouldn't really make a trade on that because it's only slightly underbought. And this is kind of weird ice here. You want it to come more like, this is even okay ice, but it's too long in between here. You want them relatively close together. Like, I'd even say possibly it could go as far as like 3 bars, like 1, 2, 3, 4. So like, if this appeared on the fourth one right there, I'd still say that's okay, but you need it to be a little bit closer. Like this 1, 2, 3, 4, 5. Yeah, I mean, like you could potentially call it that, but you see, you just got to combine it with other indicators too. Like you got to combine it with our RSI, our fear greed, our yin yang A, our volume, and you got to make a conclusive choice. And no matter what, no matter how much information you have, you're never going to be right 100% of the time. But you know, it's just being as educated as possible that's going to be helpful. So, likewise, here for this big momentum swing, this that would have been a pretty hard one to call. And we're going to turn volume on in a second, just so you can see. But I'm pretty sure the volume is what is the reason that this made such a big impact, even though it was pretty much only just not even slightly underbought, really. It was a little bit underbought, but not even like that much. Let's turn on the volume just so you can understand why this small little mountain played such a big role for this big push. So with volume, I generally just use regular. You don't want too much on the chart, and this is already enough in my opinion that you don't want really any much more than that. So the volume here actually looks a little low. Yeah, it was. So this would have been a very hard entry to basically understand that it was going to happen just based on that alone. So if I was just looking at just Yin Yang B and I saw this, I honestly probably wouldn't have done too much of a purchase. And maybe I would have bought a little bit, but I wouldn't have done like, I definitely wouldn't have done any leverage because that's just, it's too risky to call. Yeah, clearly it ended up being pretty good, but the key isn't doing risky stuff. It's doing stuff that's a little bit more predictable. This one. This was a very, very easy one that you could, I would have gone, I might have even done leverage on that. I don't really like to do more than 3 to 5 times leverage, but hey, this is about as nice as it's going to come. Look how low the predictive is. Look how low the regular is. That's pretty nice. They both curved in really sharply right here. Both support crosses on the same one, and look how high the volume mountain is. The volume mountain, it provides strength to all of the price indicators. So whether it's a bullish or a bearish indicator, and I know I've been biased talking about bullish stuff right now, but I will talk about the bear stuff in a second. It's basically the polar opposite. But yeah, you see high volume here on the support with the ice, this with the mountains this far down, and the ice is perfectly aligned, curving in right there. That's a very, very, very bullish indicator. And now, like, we can just talk about this. So, like, the strength of this bearish indicator here. So, this is a strong bearish one, too. It would have been nicer if these mountain tops were a little bit more spaced out from each other. But even then, they're really high up there. And then they happen, both the blood diamonds happen really close to each other. So, it does indicate it's likely going to dump a little bit, but the thing is that the volume is so low. So it can be deceiving. You know what I mean? Like if you're not looking at volume and you're just looking at what the potential price move is going to happen, it can likely be a false positive. One, it might not happen, and two, if it does happen, it's just a little fake out that's going to correct really quickly. And that does that mean you can't short on it or you shouldn't sell? Well, it depends on your strategy. If you're someone that likes to, risk it a little bit and you want to sell maybe a little bit and then try to rebuy back in for a lower price, that's something. Would I short on something like that? No. It's too risky. Like you don't know exactly how far it's going to go down or if it's even going to go down at all. It might just be a single red candlestick and then boom, just pumps back up again. Like this one, like right here. Like if that was to be like if you were to somehow get some bearish indicator right here, you might just get a single little red stick and then boom, just flies back up again, and then now you got liquidated or you got your stop loss hit or something above that. So what would be something where you'd be like, oh, maybe you could short? And I'm gonna just show examples of stuff even though it didn't happen that way. Here, for instance, that honestly, I'm not much of a shorter. I have done it in the past, but I'm more of someone I'm very bullish in the sense that when I do short, I don't really use leverage that often. And I'll generally end up finding myself, I stick in the trades longer, and they're just more stressful in my opinion, because I'm okay waiting bullishly, but waiting when you're shorting doesn't appeal to me as much. But if you are a shorting type of person, seeing them this high up, they're both, even the regular is above the very overvalued line. They're super high up there, about as high as you can pretty much go, 96 for or 98 for the predictive. These blood diamonds are pretty close together. They're not the same, they're not two, but they're pretty close. They're still within that sweet spot, and the volume's high. So I would say that would be a good time that you could. Although, as you can see here, you would have gone in on this confirmation right here, and that would have been a bad call. So it does happen. Like I said, you're not going to be right 100% of the time. And I wouldn't place trades solely off the oscillator. It's something to help you make a judgment call on. So I think that basically explains how to use the oscillator and when to use it. But there might be something you're wondering, what are these tables over here? So these tables are basically displaying, and you can modify which data you want to see in there, just simply going in here. Like say you didn't want to see the 1 month and you wanted to see the 30 minute. Well, you can change that. And it basically, what it shows you is, so you're not changing time frames all the time, and you can just stick on whatever you like to stick on. Basically, it shows you what is the current thing, because there's always going to be either, it's always in support cross or blood diamond mode. It can't not be in either. It's always in one. So it tells you what it's currently in and how much effect the price has had since that indicator, since that signal has popped up. So on the 1 day, you can see we got the support cross right here. So it would have started at 26,260 roughly. So you can see we're down 1.76% from when that last signal had appeared. So that's basically how it works, and you can see that on different time frames for how much it's up or down on each. So far, the only thing that's even up is on the 4 hour, we're up 0.16% from when that support cross appeared. It's useful information I find for knowing trends. So like if you're basing most of your judgment on the 1 day, well, you can see that we're still in a blood diamond on the 1 week, and it's put it down 13%. So it's just something to be aware of, I find. And we are going to conclude there for how to use Yin Yang B. As always, if you want to purchase our indicators, a link to our website is in the description below, along with a coupon you can use at checkout for 5% off. Also, if you haven't already, make sure to join our Discord, as affiliates advertise their affiliate codes in there, which you can get another 5% off at checkout. And yeah, also, if you have any questions, feel free to ask us in our Discord, here on YouTube with comments, or create a support ticket on our website. All right, thanks for watching, and have a great day, and happy trading.